This weekend, while most Americans were doing what people do in May, grilling in the backyard, calling their mothers, watching the game, some of the most powerful banking executives in the country were doing something else entirely. They were rushing into Senate offices in Washington, D.C., not because of a banking crisis, not because of a recession signal, not because of any market emergency showing up on CNBC. They were there because of a bill. 312 pages, over 100 proposed amendments, and a title that sounds like regulatory paperwork: the Digital Asset Market Structure Act, otherwise known as the Clarity Act. Now here's what should make you stop. The banks are not treating this like paperwork. They're treating it like a threat to infrastructure they've spent a century building. And when institutions that large move that fast, with that kind of urgency, the reflex of a serious analyst is not to look at what they're saying publicly. It's to look at what they're afraid of, because they don't tell you that part. Quick note before we go deeper. Everything in this video is for educational and informational purposes only. It is not financial advice. Markets involve real risk, and any decisions you make should be based on your own research and judgment. If you're new to the wealth continuum, this channel exists to map financial shifts before they become obvious. Subscribe if that's the kind of thinking you want more of. Now, let's actually understand what's happening here. The Clarity Act has been circulating in various forms for years now, but what dropped in the days before the Senate markup was different. This wasn't a placeholder. This wasn't a framework document. This was a dense operational legislative text, the kind of bill that has actual enforcement language, jurisdictional definitions, regulatory boundaries, and liability frameworks buried in its subsections. And the moment it became public, two things happened almost simultaneously. Markets started moving, and bank lobbyists started making phone calls. That combination tells you something that the headlines won't. To understand why, you have to go back to the question that has haunted crypto since the very beginning, not whether Bitcoin is a scam or a revolution. That conversation is long over. But the question that actually strangles innovation at the legal level: what is this thing? Is a token a security? Is it a commodity? Is a decentralized protocol a financial intermediary? Can a developer be legally liable for how a protocol they wrote gets used 3 years after they stopped touching the code? These aren't abstract philosophy questions. They determine who regulates, how, with what consequences, and who faces prosecution if the answer turns out to be wrong. And for years, the American answer to these questions has been unclear. The SEC has claimed jurisdiction over nearly everything with enough force to frighten developers. The CFTC has claimed jurisdiction over commodities, which includes Bitcoin, and has been notably more restrained. Courts have issued conflicting rulings. Agencies have been at war with each other in slow motion. And the result? Billions of dollars in infrastructure, talent, and capital quietly migrating toward jurisdictions that made clearer decisions faster. The Clarity Act is designed to end that ambiguity. If a digital asset network is sufficiently decentralized, meaning no single entity controls it, no one can change the rules unilaterally, and the network functions without a central authority, that asset may now qualify as a digital commodity under federal law, not a security. That's a seismic distinction. Commodity classification means CFTC oversight. It means less restrictive disclosure requirements. It means the liability burden for developers is dramatically lower. It means institutional infrastructure, custody, clearing, accounting, can be built with predictable rules instead of regulatory guesswork. That sounds like a policy wonk conversation. It's actually a capital flows conversation, because the money that has been sitting on the sidelines waiting for legal clarity, and there is a great deal of it, now has a potential framework to work within. The market already knows this. That's why the positioning has been shifting for months. But here's what most of the commentary is missing. The decentralization test isn't just about Bitcoin. It potentially applies to the broader ecosystem of networks, protocols, and infrastructure that has been built over the past decade. And some of that infrastructure, if reclassified under the Clarity framework, begins to look less like a speculative asset class and more like the early scaffolding of an alternative financial system. That is the part that woke the banks up. Let's talk about stablecoins, because this is where it gets genuinely uncomfortable for the traditional financial system. Stablecoins are, in simple terms, digital dollars. They're blockchain-based tokens pegged to the value of the US dollar. You can send them globally in seconds at near zero cost without a bank intermediary. You can use them in decentralized protocols. You can hold them in self-custodied wallets that no institution can freeze, block, or control. Over the past several years, stablecoin transaction volume has grown enormously. It now regularly competes with, and at certain points surpasses, traditional card network volumes on a daily basis. That's not a projection. That's already happening. The earlier iteration of stablecoin legislation, the Genius Act, included a provision that banking groups fought hard to keep in place, a restriction on stablecoin issuers paying direct yield to holders. think carefully about what that restriction is really doing. It's not protecting consumers, it's protecting the deposit model. Because here's the thing, banks understand better than almost anyone outside of institutional finance. If you can hold a digital dollar in a self-custodied wallet and earn meaningful yield on it through decentralized infrastructure without a bank account, without a credit application, without counterparty exposure to a financial institution, then the fundamental reason to keep your money in a bank starts to erode. Not collapse, not immediately. Erode. Banks rely on deposits the way a power grid relies on baseload. Deposits are not just savings accounts for customers. They are the raw material the entire lending apparatus runs on. Mortgages, commercial credit, credit cards, business lines. All of it is built on a foundation of deposit liabilities. If even 5% of deposit-eligible savings gradually migrated to self-custodied digital dollar systems that offered competitive yield, the downstream math becomes genuinely painful for certain institutions. And the Clarity Act, in its current draft form, contains language that could begin to open that door. Not throw it open, but move it off the latch. The language around yield-bearing instruments in decentralized contexts, combined with the self-custody protections elsewhere in the bill, creates a framework where the yield question may no longer be permanently settled in the bank's favor. That's what the rushed lobbying weekend was actually about. Not Bitcoin, not crypto speculation. The slow structural erosion of the deposit monopoly. Now pause here for a second because I want to make sure the full picture is clear, because there's another layer of this bill that almost nobody is talking about, and it's actually the part that changes the longer-term trajectory of the entire industry. The Clarity Act includes explicit protections for developers, for validators, for node operators, for wallet infrastructure providers, for anyone who writes code that contributes to a decentralized network. And this matters in a way that goes far beyond legal technicality. For years, one of the quiet existential fears in crypto development has been this: at what point does writing software that facilitates financial activity make you legally responsible for that activity? Could a developer who wrote a protocol 3 years ago face enforcement action because someone used that protocol in a way the developer never intended? Could running a validator node, essentially a piece of computing infrastructure, make someone a regulated financial entity? These aren't paranoid hypotheticals. Enforcement actions and regulatory pressure over exactly these questions have already played out in partial form against certain projects and individuals. The Clarity Act, if the developer protection language survives the amendment process intact, draws a meaningful line. It says, writing code for a decentralized network is not financial intermediation. Validators are not money transmitters. Infrastructure providers are not custodians, subject to securities law by default. Consider what happens if that becomes US law. Every developer in Europe, Asia, or Latin America who has been considering whether to build in the United States, and who has been hesitating precisely because of that legal uncertainty, now has a potential answer. Every venture fund that has been structuring projects offshore to avoid US regulatory exposure now has a reason to revisit those decisions. Every institutional investor who has wanted exposure to early-stage infrastructure projects but has been blocked by compliance departments citing legal risk has a new conversation to have with those compliance departments. Markets price expectations, not certainties, expectations. And the expectation being priced right now is that the United States may be completing a transition from the most legally hostile developed nation for crypto infrastructure to one of the more accommodating ones. That shift in narrative, from adversarial to integrating, is worth understanding carefully because it's the kind of shift that compresses time on adoption curves. But here is where the analytical instinct has to push back against the excitement for a moment, because the substance of this bill is only part of the story. The arithmetic of passing it is another problem entirely. Major Senate legislation, to move past the floor procedurally, typically requires 60 votes. That's the supermajority threshold that effectively forces bipartisan cooperation. 60 votes in the current Senate. Think about what that requires. There are Republicans who have been enthusiastically supportive of crypto in principle, but remain genuinely skeptical of DeFi, of self-custody at scale, of anything that could potentially be used to evade sanctions. Their concerns are not irrational. There are Democrats who see digital asset infrastructure as a potential regulatory arbitrage vehicle, a way for sophisticated actors to recreate shadow banking with better branding. Their concerns are not irrational either. There are members of both parties who want provisions in this bill tied to ethics concerns around digital assets connected to current and former political figures. That debate is happening now in public, and it has the potential to poison the well even for senators who broadly support the policy direction. And behind all of them, working the phones and the donor networks and the Senate staff relationships that actually drive legislative outcomes in real time, are the banking lobbyists, who are very good at their jobs. The amendment count, over 100 as of markup, is itself a signal worth paying attention to. not because each amendment matters equally, but because in Senate procedure, amendments are often vehicles for delay, for extracting concessions, for attaching unrelated political priorities to legislation that already has momentum. One strategically placed amendment on AML compliance, or on foreign entity restrictions, or on the tax treatment question, any of those could fracture the coalition that this bill needs to pass. So while the direction of travel is clearly shifting, the path is not straight. And understanding that is not pessimism. It's the kind of calibration that keeps you from being whipsawed when the timeline doesn't match the narrative. What is certain, regardless of this specific bill's fate, is that crypto regulation has moved from the fringe of Senate priorities to the center of a genuinely contested legislative fight. That's a structural change in political status. Once an industry gets there, the trajectory doesn't reverse. Now let's zoom out further, because there's a geopolitical dimension to this that rarely gets discussed with enough seriousness. While Washington has been working through years of regulatory uncertainty, other financial centers haven't been waiting. The United Arab Emirates established a comprehensive digital asset regulatory framework, the VARA framework in Dubai, and has been actively competing for institutional crypto infrastructure with a combination of regulatory clarity and favorable tax treatment. Major exchanges, trading firms, and infrastructure companies have established regional headquarters there. Singapore has operated with a licensing framework for digital payment token services that has given institutions a clear operating environment. It's become a hub for Asian crypto capital flows in ways that didn't exist 5 years ago. Hong Kong, despite and in some ways because of its complex political situation, has made an aggressive push to position itself as an Asian institutional crypto hub, with regulatory frameworks for spot ETFs and licensed exchange operators that are, in certain respects, more advanced than equivalent US frameworks. Parts of Europe, through the MiCA regulation that came into full effect in 2024, now have a continent-wide regulatory passport system for crypto asset service providers. Imperfect, still evolving, but operational. The United States is still completing its first comprehensive federal market structure framework. That gap has costs that are visible if you look. Developer talent, particularly in the protocol layer, the engineers who build the actual infrastructure, has been dispersing globally in ways it wasn't 10 years ago. The concentration of crypto technical talent in US cities that existed in the early part of this decade is less pronounced than it was. Capital flows have been structuring around offshore entities partly for legitimate tax reasons, but also, routinely, for US legal risk management reasons. Infrastructure for new categories of financial activity, real-world asset tokenization, decentralized lending protocols at institutional scale, cross-border payment infrastructure, has been launching from jurisdictions where legal questions have clearer answers faster. Washington is aware of this, and this is one of the forces actually driving the accelerated timeline on clarity. The question is no longer purely domestic. It's whether the United States wants to lead the next iteration of financial infrastructure, or cede that ground gradually to jurisdictions that moved earlier. When you understand that frame, the urgency in the Senate around this bill starts to make more sense beyond the domestic politics. There's one more layer here that almost nobody in the retail investing conversation is engaging with seriously yet. The Clarity Act may be phase one. If it passes, and I want to be precise, if it creates a jurisdictional and definitional foundation that then makes the next battles much more tractable. And the next battles are about taxes. Crypto taxation in the United States is currently structured in a way that is genuinely hostile to everyday use. Every transaction involving a cryptocurrency is potentially a taxable event. Every swap, every payment, every use of a token in a protocol interaction. Each of those triggers a capital gains calculation based on cost basis. For holders who have been in the space for multiple years, with multiple positions across multiple protocols, the record-keeping burden alone is significant. For casual users trying to use a stablecoin to pay for something or participate in a simple yield protocol, the tax compliance overhead can be wildly disproportionate to the economic activity. There are already active discussions, not as advanced as the market structure conversation, but genuinely happening in policy circles, around several specific reforms. A de minimis exemption, setting a transaction threshold below which crypto transactions don't trigger reportable taxable events, similar to how foreign currency transactions under a certain amount aren't treated as taxable events for most taxpayers. Clearer guidance on staking rewards, whether they should be treated as income at the time of receipt, as property, or under some other framework that better reflects their economic character. Mark-to-market accounting alternatives for institutional digital asset holders, which would simplify the accounting treatment and potentially make institutional adoption of digital assets far more operationally manageable. None of these are law. Some of them are at the discussion stage. But here's the strategic logic. Major tax reform on digital assets in the current legislative environment is very difficult to pass as a standalone bill. The political lift is enormous. But if clarity passes and establishes legal clarity on what digital assets are, it becomes much easier to argue in subsequent sessions that the tax code should reflect that clarity. The definitional work done by clarity becomes the foundation for the tax argument that sequencing is not accidental. People who have been working this in Washington understand the legislative strategy, and the downstream implications are significant. If de minimis exemptions passed for small crypto transactions, it removes one of the most persistent practical barriers to actual consumer use of digital assets as a payment medium. If staking taxation got rationalized into a clearer, more favorable framework, it changes the economics of participation in proof-of-stake networks for retail and institutional holders in meaningful ways. If institutional accounting standards simplified a category of institutional investor that currently cannot hold digital assets due to accounting treatment complications, certain insurance companies, certain pension structures, certain trust vehicles could gain a pathway to exposure. All of that capital waiting behind those regulatory and accounting walls is not small. So when I say watch Washington, I don't mean watch the price on a chart and check whether a vote happened. I mean understand the sequencing. Understand that clarity, if it passes, is not an ending. It's a foundation. Now let me tell you what I actually think is the most underappreciated dynamic in this entire story. It isn't the technology, it isn't even the regulation, it's the timing. We are at a moment where a convergence of separate forces is compressing into a relatively short window. Spot Bitcoin ETFs have now been live in the United States for over a year and have accumulated hundreds of billions of dollars in AUM. That infrastructure didn't exist 2 years ago. Institutional on-ramps are now operational at a scale that changes the capital availability calculus entirely. Real-world asset tokenization, the process of putting traditional financial assets like U.S. Treasuries, private credit, real estate, and even commodities on blockchain infrastructure, has moved from proof of concept to operational. Multiple major asset managers are running live products in this category. The total notional value of tokenized real-world assets has grown by multiples in the past 12 months. Stablecoin infrastructure is being built into payment systems that are already processing significant daily volume. And now, overlapping with all of that operational progress, the regulatory framework that could institutionalize it is being actively negotiated. The internet went through a similar convergence in the mid to late 1990s. Dial-up was still the primary access technology. Most people still didn't think of the web as something that would reorganize commerce, communication, and capital formation. The legal frameworks for online contracts, digital signatures, and e-commerce were being debated in Congress. And then the infrastructure and the framework matured together in a relatively compressed period of time. And companies that understood the compounding of those forces early, not the speculators, not the day traders, but the people who understood the architecture being built, were positioned very differently from those who discovered it when the outcomes were already priced. I'm not saying this repeats identically. History rhymes, it doesn't copy. But the structural parallels between the late 90s internet framework build-out and the current digital financial infrastructure build-out are serious enough that serious analysts are making that comparison with real analytical rigor. And the Clarity Act, whether or not it passes this session, sits at the intersection of that build-out. So let's come back to the banks, because that's where this started, and it's where the real signal lives. Major banking institutions are not naive organizations run by unsophisticated people. When executives at these institutions rushed into Senate offices in Washington on a holiday weekend, they weren't panicking over a bill that might cause minor friction in crypto markets. They were responding to a reading of long-term competitive dynamics. The traditional banking model extracts value primarily at a small number of structural choke points. The custody choke point, you need someone to hold your assets. The yield choke point, you need an institution to lend out your money and return you a fraction of the return. The payment choke point, you need infrastructure to move money from point A to point B. The credit choke point, you need an institution to evaluate your creditworthiness and decide whether to grant you capital. Decentralized financial systems, at scale with legal clarity, begin to apply competitive pressure to each of those choke points simultaneously. Not replace, not overnight, compete. The self-custody language in Clarity applies pressure to the custody choke point. The yield discussion around stablecoins applies pressure to the yield choke point. The stablecoin payment infrastructure applies pressure to the payment choke point. Decentralized lending protocols, once they operate under a comprehensible legal framework, begin to apply pressure to the credit choke point. None of this dismantles the banking system tomorrow. Financial systems are deeply embedded in legal, regulatory, and social infrastructure that evolves slowly, but competitive pressure on multiple choke points simultaneously over a period of years, in an environment of legal clarity rather than legal chaos, that changes the trajectory of the industry. And the banks know this. That's not speculation. Their lobbying response this weekend was the clearest possible signal that they know this. And here's the question that matters most for anyone watching this video. Do you? Let me be clear about what I'm not saying, because intellectual honesty is the only thing that makes a channel like this worth watching. I'm not saying the Clarity Act definitely passes this session. I'm not saying DeFi eliminates banks within a decade. I'm not saying Bitcoin becomes the global reserve asset. I'm not saying any specific asset is a guaranteed winner in the environment being built. What I am saying is that the architecture of financial intermediation is being contested seriously for the first time in a very long time. That the legal frameworks being negotiated right now will shape capital flows for years. That the institutions with the most to lose from a renegotiated structure are responding with the urgency of entities that believe the stakes are real. And that most retail participants in financial markets are focused entirely on price charts, while the more consequential game is being played in legislative markup sessions, regulatory comment periods, and banking industry boardrooms. The public sees price action. The people writing the rules see structure. And structure outlasts price action every single time. Here's what comes next, and this is the part to hold in your mind as the news cycle moves forward. The Senate markup process will produce a revised bill. Amendments will be negotiated, some adopted, some rejected. If the bill clears committee, which appears likely at this stage, though not certain, it goes to a floor vote where the 60-vote math becomes the central variable. Watch the bipartisan signals. Watch whether the handful of Democratic senators who have historically been crypto-friendly, and there are several, hold together under lobbying pressure and internal party friction. Watch the specific amendments that survive, the developer liability language, the stablecoin yield language, the self-custody protections. Those are the provisions that determine whether this bill, if it passes, is actually transformative or mostly cosmetic. And watch what happens internationally in response to whatever the Senate does. The global competition for digital financial infrastructure is real and ongoing. A U.S. bill that leans aggressively toward restriction could accelerate offshore capital flight. A bill that leans toward integration could accelerate the repatriation of capital and talent that has been dispersing for several years. Both of those outcomes have downstream effects that extend far beyond crypto markets. The biggest shifts in financial history never announced themselves clearly while they were underway. The Eurodollar market grew in the 60s and the 70s in a way that fundamentally restructured global dollar flows, and most American investors had no meaningful awareness of it until decades later. The securitization of mortgage debt transformed the U.S. credit system over 20 years in a way that the participants closest to it didn't fully understand until the system found its stress point. The internet's restructuring of retail, advertising, and media happened in a way that seemed slow and then suddenly wasn't, and the investors who were positioned early for the second phase, not the speculative first phase, but the structural second phase, were the ones who captured the compounding. The Clarity Act is not the beginning of this story, but it may be the moment the story becomes impossible to ignore for the institutions that have been hoping it wouldn't become their problem. That they hoped wrong is now visible in their weekend lobbying schedule. The question isn't whether this is happening. The question is whether you're watching closely enough to understand what it actually means before the interpretation becomes consensus. Because once something is consensus, it's already in the price. If this video changed how you're thinking about the intersection of regulation, banking, and digital finance, not as a crypto story, but as a structural financial story, drop the word clarity in the comments. I want to know how many people watching this are actually thinking at this level. And while you're down there, what should we go deeper on next? The tokenization of real-world assets and what it actually means for traditional bond markets, the tax reform sequencing, and which changes would have the most immediate impact on market behavior, the geopolitical race for digital financial infrastructure, and which jurisdictions are actually winning it, tell me in the comments. This channel goes where the real thinking is. If this made the picture clearer, hit like. It tells me to keep going deeper on exactly this kind of analysis. And if you're not subscribed yet, you should know. The next few months are going to produce more signal than most investors will know how to read. This channel will help you read it. I'm watching the same things the institutions are watching. This is the Wealth Continuum. I'll see you in the next one.